Hey there guys, welcome back to my channel. When it comes to trading, the landscape is littered with countless indicators, strategies and methodologies. But today we are going basically organic, stripping away all the noise and focusing on the purest form of trading, price action. Price action trading, a method that can not only set you apart from the indicator cluttered retail traders, but also significantly improves your chances of making steady profits. And I know it might sound a bit intimidating at first, but trust me, once you've got the hang of it, it becomes increasingly easy to understand, especially if you are familiar with Wyckoff's phases of price movement. So buckle up. In this video, we are going to break down a straightforward three-step system that transformed my perspective on price action trading from being incredibly complex to something that technically makes perfect sense. But before we dive into the mechanics of price action trading, let's set a basic foundation or understanding, if you will, for those who are new to day trading. So what exactly is price action trading? Well, in its simplest form, price action trading is an approach where you focus strictly on the analysis of the price movement of a financial instrument, be it stocks, options, crypto, futures, whatever. Instead of being lost in a sea of complex indicators and charts, you are basically zeroing in on the most basic component of trading, the price itself. You might wonder if such a simple method can really be effective. But believe me when I say that it's incredibly powerful. It's like reading a book and understanding its story without needing a dictionary to decipher every word. The plot basically unfolds through the price movements themselves, and your job is to interpret that story. So how do we interpret this story? Well, by looking for important clues in the market that point us towards high quality trading opportunities. These clues could be, trends like a series of higher highs and lower lows, support and resistance levels, price points where a security seems to bounce back or top out, order blocks, which are large smart money orders impacting the market, are also important, as are imbalances where demand and supply are not equal. Basically, the idea involves analyzing current price fluctuations to figure out the market structure, whether we are trending or ranging. The next step is to identify key price levels and search for quality trade setups along the path of least resistance, which basically means going with the trend. Now, after taking these clues, we combine them much like pieces of a puzzle. This helps us understand the structure and bias of the market, which are crucial elements in identifying high probability trades. In a way, this is like finding the elusive X on a treasury map. In essence, what we're doing is we are reading the market's body language to predict its next move. Figuring out these moves will not only increase your charting skills, but also improve your trading results. So with this basic understanding of price action, let's dive into some charts so we can walk through my simple three-step process that I use for spotting high probability trades. And this is often where traders, especially beginners who may find reading price action somewhat challenging, tend to trip up, but I'll try to be here as clear as I can. But before we do that, let me first point out that in this three-step process, there are three main data points you can obtain from the price action presented on your charts. And this is important, guys, to understand here that correctly identifying and interpreting these key points, which I will explain next, can significantly improve your market timing, when establishing a position in anticipation of an upcoming move. Okay, let's begin by addressing the first crucial data point in the process, which involves identifying market bias. Now, market bias is basically the general feeling or direction the market appears to be going in. It can be bullish, going up, bearish, going down, or neutral, sideways trend. To figure this out, you need to watch out how the prices change over a certain period. If prices keep getting higher and higher, it's a bullish trend. If they keep making lower lows, it's a bearish trend. If prices are fluctuating within a specific range without actually making significant highs or lows, it's a neutral trend or a range-bound market. One thing to keep in mind is that you can see these trending dynamics on all sorts of time frames, but I think they pack a bigger punch in shifting or holding the market's direction when you are looking at the big picture over higher time frames. Another thing to consider when determining a market trend or bias is that it's crucial to base your conclusions on the data at hand and not on feelings or intuition. Wall Street's top earners actively avoid two major types of bias: emotional and cognitive. The former is driven by fear or greed rather than logical analysis, while the latter, cognitive bias, leads traders to make irrational entries even when they are aware of the facts. Moving on to step number two. Step two is all about identifying market structure breaks. Understanding the market structure break dynamic, a concept that's considered the cornerstone of price action trading, involves recognizing critical price levels where substantial trading activity has occurred. These levels, think of them as strong support and resistance area, holding basically a large amount of limit orders that can potentially reverse the price direction. So these areas often indicate the course that the market is likely to take in the near term. A market structure break or a break of market formation is like a turning point in the trading game. It's that specific moment when the price whispers, hey, things might be about to change here. These moments of transition can be both a challenge and an opportunity. Traders who can handle these shifts well stand to gain the most using market structure breaks as their guide. Basically, guys, getting the hang of these market shifts can make a real difference in your trading. The third and final step in this trading approach involves identifying a point of interest and then establishing an entry point. This step revolves around key value areas which could manifest as a stop hunt, an imbalance zone, an order block, or even a confluence of various technical patterns converging at the same location. And now let's give a brief description of all these important technical components. At its core, a stop hunt is a smart money liquidity grabbing strategy that deliberately shifts price in a certain direction to trigger a series of stop-loss orders. It's a mechanism that deep pocket players use to nudge smaller ones out of their positions. An imbalance zone, on the other hand, refers to a price area where the market spent a certain amount of time indicating a potential disequilibrium between supply and demand. An order block, a widely utilized concept in price action trading, is a significant price level where large smart money orders are expected to come into the market. The confluence of different technical patterns in one place is another critical factor. The more technical elements, the stronger the potential trade signal. This can increase the probability of a green trade given that multiple factors are corroborating the same market viewpoint. Now, I would like to point out that this three-step method is by no means exhaustive or 100% accurate, as obviously such guarantees do not exist in trading. However, I believe it is technically, if read right, a solid technique that can help you get good at price action trading. Plus, it sets you up to grab the best trades out there. Basically, this system improves your odds of success, which is super helpful when you are still learning the ropes. Alright, let's now take a look at a couple of charts, starting with this one. Now, our first objective here is to spot the trend. If you look at this entire price action, you might conclude that the market's tendency is to keep declining. While this could hold true for the long term, a closer look at the short-term scenario using the three-step process I just described reveals a different story. As you can see from the chart, once this stop hunt expedition is completed, a pattern frequently observed near the highs of an uptrend or the lows of a downtrend, the market starts to retrace higher. Another factor that further reinforces, in my view, the market's long bias is this break of structure over here, which as an important technical element can more often than not give you a good idea of the direction of the price might take. Additionally, the absence of a pronounced downward shift during this reversal tells us the market is setting up for a move higher. Another thing to consider here is that these slight pullbacks still look, in my view, like an adjustment within a bigger uptrend, particularly when such corrective attempts fail to generate new structural lows. So at this point, evidence from this stop hunt expedition, the structural break, and the missing counter-trend momentum move all point towards an impending upswing in the market. As a result, our focus is now drawn to this particular price zone, a notable point of interest that has emerged obviously from our price action analysis. The final step in our strategy is pinpointing an entry point which I identify as this area of imbalance. As you can see, guys, by carefully studying these technical elements and incorporating them into the three-step system, we can identify high probability trades with a higher degree of precision. Okay, let's take a look now at another chart. Again, our first order of business is to spot the trend, and using Wyckoff's method, I believe it's fairly straightforward to identify the bases in this chart. Starting from the base, we can see the accumulation phase wrapping up, which sets the stage for a markup phase. Obviously, this entire cycle ends with a distribution phase followed by a markdown phase, a typical Wyckoff cycle at play here. When the market does a U-turn up here and begins its sell-off, it forms an order block amidst this pronounced structural break, effectively balancing these large imbalance zones. Now, if you identify such key price action patterns on a chart in succession, it's likely that despite some fluctuations, the market will continue its downward trend. At this point, the best strategy is to be patient and see how the market responds, as bearish factors can offer trigger retracements before the market resumes its downward trajectory. And as you can see from the chart, following some sideways action, the market experiences another surge, which this time results in the price printing inside the order block zone. This particular detail is important in my humble opinion because it doesn't just highlight the high probability aspect of this hypothetical trade, but also presents us with a potential entry point. Obviously, a stop loss order should be placed above the order block's resistance level. And again here, guys, I spotted these higher probability setups by closely adhering to my three-step price action process, which I stress is essential for getting those high quality trades. I began by figuring out the market bias, a key tool to steer me through the erratic seas of the marketplace. Next up, I focused on spotting market structure breaks, kind of like finding hidden messages in a book, helping me basically identify both opportunities and risks. The last step of the process was identifying key value areas, which, as I mentioned earlier, could materialize as a stop hunt, an order block, or perhaps a confluence of different technical patterns converging at specific price area. Only after this methodical groundwork did I pick my entry points. And be sure to check out this next video where I showcase an expanded version of this powerful technique in action. It's, I think, a valuable resource you definitely don't want to miss out on. Alright guys, thanks for watching, and as always, see you in the next video.